Because if you see the announcement in terms of jobs cut in Silicon Valley, probably it's running at around 600, 700,000 jobs cut. But we haven't seen that translate into the jobs report. So while it's good for earnings, and this is where I think if you look at the Jan month jobs report, we will be very mistaken to think that it's a great jobs report, because a lot of these layoffs have not happened. It might start flowing into the data going down the line.
Oh, interesting. So you think that 517,000 number was not as strong as the headline? But people say that actually in the tech space, it hasn't showed up because it is relatively easier for a high-skilled software engineer to get another job.
Well, that's true, but a lot of them have been announced. It doesn't mean all the layoffs have happened. And second, if you tie that to what really worried the market on that data was the ISM services number. The services number came at 55, but if you look at last 6 services number, it was already at 55 in October, September, October, November. We had a dip at 49 in December, then back to 55. But we have to look at the PMI manufacturing number, which is 47 and getting worse. So in my opinion, the jobs report, the data probably will get revised down, because you have seasonal factors. Seasonality is a huge case in that, and we should not misconstrue that the jobs market is as healthy as the data is telling us.
Let me link this, if I can, to what it means for Fed policy, because you've made the point in one of your latest notes that Powell is probably more dovish than consensus expects. What makes you say that? What signals has he given that make you confident that he is more dovish than analysts believe right now? So
let's look at Chairman Powell's motivation, or Fed's motivation. They do not want to go back to zero rates of the old days, because that was seen as a big mistake, which helped the 1% and not the 99%. So what's in his interest? To keep the rates higher even when the tightening is over. So he has to sound hawkish. That to me is a big factor. Second, if you see, and I think it was your colleague Steve Leisman who asked a great question at the FOMC presser, where he said that Fed is already at its PCE target if you look at 3-month data, and unemployment has not gone up, it's actually gone down. So what is Fed looking at? There's something else happening. It's not just about raising rates and inflation comes down. In my opinion, COVID was an economic shock. We have come out of it, we are still coming out of it. When we come out of it completely, in my opinion, we will go back to the disinflation days that we had in pre-COVID days, because nothing much has changed. Demographics is bad, technology innovation is growing, and we have even more debt. So I just don't see the basis how the rates can stay higher and we'll still be fine.
Does this mean you want to buy tech stocks here?
Well, tech stocks have sold off a lot, so I'm long tech stocks. So it's all about, I have a medium-term view, 12-month view to 15-month view when I put a trade. If you're doing a 1 month, it's tricky. But if you can do a 12-month view, then yes, you can buy some of these sell-offs. And we have seen great rally in many tech stocks.
So let's sort of piece out this narrative a little bit more. If we follow your logic, does it follow through then that you're expecting the U.S. to enter into a recession, that the data that we're getting now isn't as strong as it appears on the surface?
I think U.S., in my opinion, U.S. will enter a recession. The reason I'm saying that, even though inflation is coming down, it's only the second derivative. The price is not increasing as rapidly. The price is already high, and that is hurting consumer.
Yeah. So is that a good thing or a bad thing for stocks? I mean, for bonds, I guess it's pretty clear. In an environment where headline inflation has peaked, where we have disinflationary trends, where we go back to prior inflation trends, that's bullish for fixed income, and we've rallied a lot. But what happens to stocks in that environment?
So I would say that if you're taking a medium-term view, you will not be worried. Short-term, you will be worried, because what we have seen, the cycles have become shorter. You see a far quicker monetary and fiscal response than you have seen in the past, and which is exactly why we are dealing with inflation, because we had a rapid fiscal response and that led to this inflation. So I think that if it starts showing that there are signs of recession, you will see the Fed come in. In my opinion, we are going to see at least 150 basis point rate cut by the end of this year, whenever the Fed stops raising rates.